Hello and welcome to Mississauga Life and Real Estate Podcast. I'm your host, Sean Jaffrey, and joined with my co-host, Alex Stakic. Alex, how are you today?
I am very good. Thank you very much for asking, Sean. How about you?
Hey, man, can't complain. I think we're finally going down to zero in a couple of days, but right now I'm still enjoying the good weather.
Unbelievable, yes. I was in touch with one of my clients yesterday from Edmonton, and they told me yesterday was minus 37. And here, during that discussion, here was plus 17. So,
oh my God, you're kidding.
54 degrees difference.
Wow, that's amazing, man. I don't feel so bad anymore about, the 0 degrees around the corner. Okay.
Yeah.
Excellent. So, Alex, today we got a very interesting topic for our listeners. We're going to be talking about investing in real estate. Really, we work out of the west side of Toronto, but I think these principles would pretty much apply anywhere in Canada. One of the main things, and when we talk about, or we think about when we're talking to customers, we're thinking about investing in real estate is, hey, think about your financial situation early on and start working on it, because sometimes that process can be a long one, right? Canadian banks are extremely conservative. So even though you might have some equity in your home, you might be making some good money, good credit score, all of that in place, they want to make sure that worst case scenario, if your rental property, for some reason, your tenant's not able to pay the rent, or it's sitting vacant for whatever reason, you haven't really put it up for rent yet, you're able to cover the cost without dipping into any sort of lending situation or, taking a loan for that. And honestly, sometimes when people don't meet the very, very strict criteria that the banks have, there are other options available as well. I mean, there are B lenders, credit unions, people that you can work with. But all of this stuff, better do right now than to put an offer on a place and then find out in the financing period that you can't get it.
Yes, absolutely agree with you, because calculation is very simple. Banks are very strict giving the mortgages, especially for investment properties. And I'm pretty sure you know that you have minimum to have 20% down. But this is not only one criteria. You have to have ratio, minimum 36% ratio of your income comparing your obligations for the rental property.
Correct.
So if you don't meet this 36% minimum ratio, you're probably out of the picture. And in most cases, what I noticed, and when I'm discussing with especially pre-construction clients, they don't have any calculations and they don't have any idea about how they will close property when time comes. Everybody is talking and thinking, oh, I will sell by assignment, But when we come to the assignments, right now, the story is totally different. And I noticed, for example, for the last 5-6 days, we have so many properties on sale on the Facebook marketing ads from so many realtors for the assignments. So people are trying to find the best way how to go out, because most of them, they're not able to meet this first rule.
Yeah, because they haven't done their homework. And another side note sort of thing is that a lot of times what will happen is when you go talk to the bank about financing options, let's say you purchased your own home a couple of years back, a lot of time has passed. Things happen. When you pull up your credit reports, sometimes you'll see that a different bank account's been opened under your name. It happened to me actually once as well. And then that's affecting your credit. And to get that cleared might take a couple of months. So do that homework ahead of time, just so there's no surprises for you down the road.
Absolutely. I agree with you. And I would like to add to that point that sometimes, because of all of these shows we are seeing lover listed or whatever, or flipping is so easy.
Yeah. Oh my God. So exaggerated.
People are so excited, and they're asking, oh, find me some rundown property, and I would like to buy, and I would like to explore that option, because, a lot of money is behind the corner. And my first question is usually, is this your first investment property or not? Investment.
Right, correct.
And in, let's say 90%, they're saying no. This is my first property, so you don't have any prior experience, right? So people are thinking that buying investment property is same like buying your primary residence property. Calculation is for them same. It's not. And when you disclose them what the problems they can be faced with on their road from buying rundown property and to do upper fixtures to the moment that everything is done. Many of them, they change mind. I tried three times a real estate agent, and that drove me away from my main business, from my real estate. And when you calculate how much time you invested, how much money you invested, how many contractors and subcontractors you chased to finish their job, in spite of the fact we are daily in touch with the contractors, I figure out it doesn't work. In my personal opinion, it doesn't work in my case.
So that's a good point. I mean, when you're looking at investing, the reason why you don't want to do a flip property or to buy something that's demolished and, fixer upper or whatever the case is, I think it's very, very simple in my view. I've seen people do that in the past where they bought a property that was really, really dated or run down. They spent money, they fixed it up, they sold it, they made a profit. But then those same people did not repeat it and do it again because I think they understood that the value for the time wasn't there. So, I think the only people who are really doing this on a regular basis would be somebody who has like an entire team behind them, right? They are buying supplies in bulk, so there's a cost savings there. And because they have a committed team of people, they can do 10, 12 flips a year, maybe even lose money on one or two, but overall they'll turn a net profit. I think that's probably the only way to do a fixer-upper. Other than that, you're really, there's a big risk, a lot of time involved, and may not be worth it, right?
Absolutely.
So let's just say you go to the conventional route and you're looking at getting an investment property and you want to put a tenant in there, which is what typically when you talk about multi-property owners, that's what they do. They buy properties, they rent them out, and then they rent them out for the long term. One thing to consider, if this is your first property, is that you have to account for operating expenses, because a lot of times what we do is we think, okay, so this is the rent coming in, and the rent's going to cover this portion of my mortgage, and I'm good to go. But what you have to take into account is obviously property taxes, right?
Yes.
And you also have to take into account the expenses that are going to come up when the tenant leaves, and you might have to change the carpeting. You might have to do, change the roof shingles after 10 years or whatever it is. So all of those things you have to account for. And also keep in mind, when you're renting a property, sometimes when you put it up for rent, maybe you might not rent it right away. Maybe it might take a month for you to find the right tenant. You might be really picky about who you get into your home. And so you have to be able to cover that cost as well. So there's a whole bunch of different things that you have to kind of budget for. It's not just simply the cost of the mortgage.
Absolutely agree with you. And this is something that people are usually failing in their calculations. They're always going with some best case scenario that,
right,
highest possible rent, no vacancies, and everything is going very smooth. Yes. And they don't have even for 1 month rent to cover their costs. And then we are coming to the point that people are not prepared for unexpected circumstances. Let's say, especially these days, you have tenant who lost a job and they cannot pay the rent. What you will do then?
Yeah.
Right?
Yeah.
So bank doesn't care. They don't care you have or you don't have income from a rental property, right? And usually people do not have, especially inexperienced investors, they don't have buffer. They're looking only from positive side. And it has happened to me, for example. I was looking to rent my investment property townhouse in Brampton for 3 months.
Wow. But why did it take 3 months?
Because tenants who applied were not fulfilling. It was 3 years ago, and they didn't fulfill basic criteria. Really basic of the basic, right? Either credit score is poor or income is not sufficient, because when you match what is your gross income, and we know how much you have to pay tax and how much will be your rental cost plus utilities plus insurance plus
debt obligations if you have a credit card or a line of credit.
Of course. Yep. So it's more than obvious that these tenants cannot make it, right? So why to start that kind of trouble immediately? So, but fortunately, I'm planning my financings, and I advise everybody to plan in the way at least 2-3 months be ready that you can cover all these costs without any tenants. So
Yeah.
then this unexpected you'll be ready for unexpected actually,
Yeah.
right?
I think one of the things to add to that, Alex, would be that choose the neighborhood you're purchasing your investment property very, very carefully. That definitely has an impact, because there are neighborhoods where you know that unemployment is lower relatively compared to other places. Property values are a little bit higher. Schools are really, really good. Typically, when you have situations like these, the risks of you running into a bad tenant kind of go down significantly. So the idea would not be to, I guess, in my opinion, to buy in the most expensive area an investment property. It would be like somewhere in the middle, but where vacancy is low, unemployment is low, so you get a house for a modest price, but at the same time, the risk of tenant delinquencies is lower, right? So it's kind of find that sweet spot.
Yes, absolutely. So, in other words, that means that buying investment property criteria are not matching usually criteria of your primary residence property. Usually, we have tendency to buy the
Where we
property
live. Yeah.
where we live.
Right.
We have to have all these boxes checked, and
Yeah.
maybe that area is not investment area at all, right? But in this particular case, you're absolutely right, whatever is said. And of course, to add on top of that, what most of people are not doing is doing their calculations, very, very basic financial and real estate calculations. So one of them is what is your cash flow? And in other words, what is a cash flow? This is actually amount of money that is coming into your account and as income, an amount of money that is going out from your account as a cost and expenditures, right? So what are the incomes? Income from the rental property, income from, for example, you are renting your parking spot extra. If you have a multiplex unity, you are renting your laundry, like coin operated. When I'm going to that, let's say, higher end or condominium rental units, if you have more of them. And this is your all total income. Expenditures are mortgage, property tax, utility bills usually goes to tenants, right? You have insurance and other costs, like even legal fees, if you have evictions, and that will bring you to the line, are you in the positive cash flow, are you negative cash flow? And if you remember, in our last podcast we discussed that these days negative cash flow is around $800 a month, comparing 1 year ago when it was $400 a month, and this difference of this $400 is because increased mortgage rates, right?
Yeah,
so
this
is the
actually, yeah. Sorry, go on.
So this is the main basic number you had to figure out. Are you in positive cash flow, negative cash flow? If I'm in negative cash flow, how long I can stand for that negative cash flow, and what is motivation behind? Then second KPI number is cap rate. Why cap rate? Because cap rate by itself is actually cash flow divided with your property value multiplied with 100, and it's exposed in the process in percentage. So let's say my cap rate for this property is 3%. Is it better to have this investment in real estate, or maybe I will invest in mutual funds, I will invest in bonds, or I will invest in any other investment? So this is very important to figure out, is this cap rate something that meets your criteria and industry standards or not? And that will also give you idea, like shortcut, should I buy this property and invest my money or not? And third very important factor as a KPI is cash on cash return, and it's actually cash flow divided with your cash investment multiplied with 100 as well. So these three key points and numbers you should consider when you're buying property. Not only area, not only amenities, but numbers, because investors are looking only for numbers, no emotional attachments comparing buying your primary residence.
Yeah. And I think it's also important to kind of budget for those tenant delinquencies. It's interesting. I saw an article today where this particular landlord has this property that's been tenanted out for a year, and the tenant hasn't paid rent for a year. We're in a very unique situation right now, actually, because of the tenant and landlord board is really backed up. During the pandemic, there was some leverage given to, or some leeway given to tenants not to pay their rents because, economy was kind of at a standstill. And then that kind of like created a backlog, right? And because of that, right now, let's just say you have the article that I was reading, there was a person who had somebody in there for a year that hadn't paid rent. They had applied to the landlord and tenant board, and they're waiting for a reply still. They still they don't have a date yet. Nothing has been, nothing has been given to the tenant to vacate the property or anything like that. So you have to have, first of all, understand what are your rights, what are the tenant's rights, worst case scenario, if everything does really go down the drain. Are you able to, and again, I'm not saying this to scare people. These are not things that happen commonly, but do you have the capacity where if, God forbid, something like this happens to you where a tenant comes in for whatever reason and doesn't leave and is not paying their rent, do you have the capacity to hold on to that property for a year without it completely breaking you? Because in this particular case, when I saw this article, the person was basically living in the basement, and they had their top portion rented out, and now the tenant's not paying the rent, and the bank wants money, and it sounds like he's losing his home because he's not able to keep up with the payments. So not a common occurrence again, but just something to consider when you're doing that. Know what your rights are, know what the red flags are. When do you kind of figure out like, okay, this is going to end up in a problem? And all that. So, and obviously, to curtail all these things, we do have to do our due diligence, right? We need to know what type of tenants we're looking for. And this is why, when we talk about vacancy rates, okay, fine. It may take you a month, 2 or 3 months to find the right tenant, but it's worth it because you don't want somebody in there who's there for a year and not paying rent. So, yeah, I would say that to understand the legal ramifications, to understand what your rights are, to understand what the tenant's rights are, super important. Understand that before you get into it.
Absolutely. And moreover, I absolutely agree with what you said. And I cannot imagine how these owners who are living in the basement are frustrated and depressed. Oh my God. They don't have idea what is the solution. And
I mean, you might lose your home. Yeah.
Unbelievable. Really unbelievable. Yeah. So one of the solutions could be, instead of trying to do on your own, because people are trying to do on their own. They're trying to rent on their own, trying to save on commission for the real estate agents. Okay, then try to hire a professional management company who will do that for you, and all liability will be on that property management. And that property management it doesn't matter it's in the long term or it is on the Airbnb terms, because these property management companies, they will collect the rents, they will do advertising, they will address the problems, they will try to solve the problems, and in return they will charge you 5 to 10% fee of the gross. So this 5 to 10% costs is nothing comparing not paid rent for 1 year. On the other hand, if you have Airbnb property, you can expect 20-25% even fees from the Airbnb companies for their services, plus cleaning fees, but your income will be significantly higher in the Airbnb scenario compared to the long term, right? So don't try to do everything on your own. You're saving your time. You're not managing that property on your own, and property management company is taking all these risks for you. So actually you're getting white glove service, in other words.
Yeah, it's interesting. I think that Airbnb has taken quite a bit of share in the rental market. I personally know several people who are using Airbnb. Prior to that, they had tenants in there for 1 year term, 2 year terms. And Airbnb for them seems to be less of a headache because once you have a tenant in there, like we mentioned, and they get stuck and they can't leave, or the tenant and landlord board is backed up and all that stuff, you don't have those situations typically with Airbnb. People come in for short term, they leave. It's a bit of an investment. You can buy some furniture, set it up, take some pictures. But once you're set to go, you don't have to deal with the headache of the tenants. Now, is that a good thing or a bad thing? How long it'll last, I don't know. Right now, I know that the Airbnb market is booming. Anybody who's getting into there is saying, why did I not do this sooner? It's less headache, more money. You're paid guaranteed, right? Because Airbnb is getting paid and then you're getting paid. So, yeah, that's a very different angle. And I think it's going to be interesting to see, because I imagine at one point what's going to happen is, because of what we're talking about, what's being talked about in the news, people are going to get to the point where they're going to say, hey, why don't I just do Airbnb? And we're going to have less and less homes on the market available for rent for people who want to live there. So, and at some point, Alex, it's going to get saturated, right? At some point, I don't know when this is going to happen, but is it possible that you're going to have so many Airbnbs that people are going to say, hey, there's so many of them, the prices come down, I might as well put my house up for rent for a year. Who knows? These are interesting times.
Yes, right? Who knows? Absolutely. Because, for example, we got one project, pre-construction project in Kitchener. 1 bedroom, no 1 bedroom plus then, 1 bedroom, I believe so. Closing is 2027. Builder is giving $3,000 rental guarantee for 2 years in 2027 for 1 bedroom. Can you imagine? $3,000 2 years for 2 years rental guarantee. So if they are giving now in Kitchener $3,000 rental guarantee 5 years from now, what will be with the rental market here in Toronto, Mississauga?
Yeah, I think they feel confident about doing that, Alex, to be honest with you, because of what the situation is with our building, our home crisis here. And we don't see it right now, but like we talked about in previous podcasts, there is a crisis coming up. The builder's very confident we're not going to have enough housing units, enough single family dwelling units. So yeah, we'll get $3,000 rent in 2 years, and in 4 years that might be $3,500. The way things are going, who knows?
Yeah, of course.
Yeah, they need to get on it and solve this problem. Getting back to the whole investment angle, there's ups and downs. There's pros and cons to investing in real estate, especially when you're thinking about getting something and then putting it up for rent for a year or two. But the key thing to keep in mind, I think, is that this is a long-term game, right?
Absolutely.
If you're looking at real estate and thinking look, I'm going to get this rental property and I'm going to rent it for 3 years. It's going to go up in value. Then I'm going to sell it and take the money out. Don't do that. That's bad. Stop thinking like that. Think about it long-term. I guess you need to have a good reason when you go into investing in real estate or stocks or bonds or whatever it is, whatever floats your boat. What's your why? Why are you doing this? If you're doing it because, hey, one day my kids are going to need the money from this for education or, something that's a worthwhile cause, you'll stick it out. But if you're thinking 3-year term, 4-year term, 5-year term, you're taking a big risk. And I think the why is important. Get into it with a long-term perspective. This way, any problems that you may incur, like we talked about, delinquent tenants or something like that, in the long run, the net situation will be positive for you. So I would say at least keep a 10-year term when you're looking at an investment property.
I absolutely agree, because this is the only way how you can leverage your capital on the long run and to plant investment seeds, even in different way of investments. But these investments properties, they will not be cheaper. The rents in Canada will not be cheaper. So this is only game's number. So before you make decision you want to sell, you have again to come back to your why first I bought.
Correct.
What was my intention at the very first time when I was buying? And then if you have to sell, what I'm always asking people on listing presentation, you want to sell or you have to sell? Because if you have to sell, then this is totally different discussion. But if you just want to sell or test the market, this is totally different. And I'm trying people to convince don't sell. Because this is, I'm saying, you're milking cow for you and your kids and grandkids, and to leverage that on the long run. But right. Different people, different strategic ideas. Sometimes it's something is changed in the life that you have to sell, and this is a totally different story. But at the end, we are always coming to the very first point. you have to be aware of your mortgage capacity as a first thing you have to figure out in order to be able to look for investment property. If your numbers are not matching, if you have high ratio right now debts, and it's not possible to have, profitable property on the very end, be patient, work more on the savings, and then jump to the market. Last week I was on one meeting with one of the marketing companies who are working for builders, and it was clearly stated 5-6 years ago, you as an investor were able to have positive cash flow with 20% down payment. These days, based on
probably double.
It's 27 to 30% to be on the break-even numbers.
For a freehold property, I would think, not for a condo.
Yeah, for the freehold, right? So if you're looking to be at least break-even, you have to have 27 to 30% down payment.
Yeah, 30% down payment.
And this is reality. So yeah, of course. So they made their.
Hey, I got an investment question for you. Okay.
Mm-hmm.
So you have a set amount of cash you want to invest. You have the option of getting like a condo apartment in Mississauga. Okay. Mm-hmm. And your cost is going to be about 600,000. Let's just say, right? Mm-hmm. Or one bed is probably what, 550 right now. Roughly. Yeah. So 550. I have an option. I can get a condo in Mississauga, 1 bed, 1 bath in the Square One area. Great area, great location, lots of things happening there. I'm close to Toronto as well. Okay, that's one option. The second option is I can get like a freehold townhouse, nothing new, probably older. Let's just say somewhere in Cambridge. What's a better option for me to invest in? What's a better return on investment in the long term?
It's a good question. We should crunch the numbers and based on the numbers to make final decision. Because if you're buying condo in Mississauga, definitely appreciation will be higher. With 20%, you will have definitely negative cash flow right now. It's out of any question. Cambridge, if you have property with a legal finished basement, you will have instant positive cash flow, but it doesn't mean that in the long run appreciation of property will be so high like appreciation of your condo. Depends what you want. You want quick wins, or you want to work on the long run.
But we just said, I mean, well, at least my opinion is, I think at least 10 years, right?
Yes.
10-year time frames. And the reason why I bring this up, Alex, I'll tell you, it's a very interesting story. So what happened like about, the first, not the first, I don't know if it was the first, but there was a financial crisis in the States and all the property values came down like crazy. It was about 10 years ago. Cause I think, I think it was about 10 years ago. So what happened was in my old brokerage, these guys came from Florida, right? From Orlando. And they were like, hey, because of the meltdown, because of the financial crisis, all the value prices have come down so much. You can get like a brand new or 2-year-old, 3-year-old townhouse, 2-bedroom, 2-bath, or whatever it is, in Orlando, Florida. The weather's beautiful, it's nature, it's just amazing.
Disneyland.
$60,000. You can get a new condo townhouse, and the maintenance fees were negligible. They were like $80 a month or whatever it is. HOA fees, I think they call them. And he's like, the time, it's amazing. He's like, I bought one, my wife bought one, my ex-girlfriend, I even sold her one. It was just like, everybody's buying one. You have to get these. And these are guys coming from the States, from Florida, telling people in Canada to buy these properties in Orlando, right? We talked about it. We're like, wow, that's amazing. $60,000 for a townhouse in the United States of America. That's amazing, right? Why wouldn't anybody want to get that? Anyways, so I looked into it. I did some research. And so what I found was the areas where they were selling these properties were like an hour 20 minutes away from like the core of Orlando, like downtown Orlando. And at that time, 10 years ago, when I looked into, okay, what's the cost of a 2-bedroom condo in downtown Orlando, it was starting at like $250,000 US. right? So but the lesson for me, or for everybody listening here, was that at that time when the crash happened there and values were like really, really low, like brand new townhouses for $60,000, the core of the city wasn't cheap. It was still $250,000 US 10 years ago for a condo in Orlando, downtown Orlando. So, you know, when I talk to people about investments, I say, hey, look, one of the key things is, you know, the location is important, right? So the closer you can get to the core, the better it is. Then the question comes up, okay, but what if, like, you know, I'm getting a condo townhouse, or sorry, a condo apartment in the core, but I'm getting a freehold property an hour away. What's better? My take, I always say the condo's better. It's closer, it's better, it's better quality of life, and in the long run, I think it'll net you more money. But if you're comparing apples to apples, it's like if we're talking about a one-bedroom condo in Mississauga versus a one-bedroom condo in Guelph or Kitchener or something like that, what's the better investment? 110%, it's the condo in Mississauga, without a doubt.
Yes, of course. Absolutely. Absolutely, I agree with you.
All right. So, I mean, you know, I think the gist of Alex, what we're talking about today is do your homework and plan long-term and really know the ins and outs of the legalities of investing and, well, not really investing, but with the tenants. And you should be okay, because overall, people, you know, I was reading some stats about 7 or 10% of investors own more than 5 units, 5 dwelling units. So it's working. So people are doing it, right?
Absolutely.
It's making money.
Yes.
But you just got to go.
And knowing your why and
knowing your why. Numbers. Yes. Correct. Agreed 100%.
Yeah.
Awesome. So I think we have covered quite a bit here. If you guys, anybody listening to this has any questions, please feel free to reach out to us. Let us know. We'd be more than happy to help. And I think that about wraps it up. How about we see you next week, Alex?
Yeah, Sean, of course, with new topics.
All right.
I wish you the best for the long weekend, and see you soon.
Thank you so much. We'll see you next week.
See you. Bye-bye.